Okay, this video is going to be me navigating these difficult price conditions after the Black Swan event this morning. So originally I'm looking for this to become an inversion fair value gap and then trade down into those relatively equal lows. I now see that there's a really big green candle, so I'm going to switch my bias and I'm going to potentially take a trade toward the upside into my other potential draw, which was this breakaway gap and the relatively equal highs we're seeing now. So because we're about slightly above equilibrium, if I'm going to take an entry, this is the optimal spot. I want to get in with multiple contracts so I can build up to a favorable position and potentially hold beyond this target. However, I don't manage to get any entries. Right here I'm entering on these old relatively equal highs, that's why I just put that little buy limit. The idea is that if it can trade down, it can use that as support and then rally higher again, but unfortunately it doesn't give me that entry. I now look to add another one at the upper quadrant here. It takes a little bit of a while to load because of the TradingView demo account. It also doesn't give me that entry, just runs pretty quickly. That's okay. I trail my stop loss, I take those limits off, and now I'm looking pretty confident that it's going to hit this take profit at the relatively equal highs. On the right side of the chart, that's the regular trading hours chart, but I'm seeing this bounce price range. And as we know the bounce price ranges, we expect spooling to happen almost immediately, especially with an overlapping wick followed by, a wick overlapping another wick if you're bullish. If it's like you can see right there where they meet in the middle and they overlap, it shouldn't return to that, and definitely shouldn't return to that for very long if it does. If it does return to it, you want to see it stay in the upper half, ideally the upper quadrant, and you shouldn't see a body close in it at all. So that is the take profit on this trade, and that's like, what is that, like $1,100. This is a separate recording now, so you've seen this cut. That's because I wasn't actually planning to take another trade, but then I saw the chart and I thought, you know what, this looks good. So here I'm looking for an inversion fair value gap, and I think, okay, I had to switch my bias earlier because it had a big rally. Now maybe my original bias is correct and I can look for it to for the market to engage in a sell program that goes into relatively equal highs, or relatively equal lows rather. So here I want to see an inversion fair value gap. I'm also considering in my head that we do have the bounce price range below us, but if we get an inversion fair value gap with a strong closure beneath it, the bounce price range shouldn't be a problem because we just swept buy side liquidity. You'd also want to look at the time in the bottom right of the chart right now. I'm conscious that this is going to be a bull flag setup, so what's going to happen here is I'm going to do the opposite of what a retail trader would do. They're going to see this as a potential buying opportunity because it's just had a big run up, then it's going to consolidate a little bit inside the fair value gap before dropping through it, which will essentially go against anyone who's looking at buying this because a bull flag pattern. So a retail trader, they use all these patterns and stuff, they see this as a bull flag, they want to buy it. I want to do the opposite because as ICT traders we know that the market's likely to cannibalize those retail guys. So if we're doing the opposite of them, we're more likely to win. Here I'm just waiting for it to close below the inversion fair value gap. It did, and I enter a position, and I enter another one as it touches the low of the inversion fair value gap. My partial is at those relatively equal highs from earlier. I was trying to enter on those earlier, but now I'm going to put my partial profit there. And I want to see it stay rejecting the lower half of the inversion fair value gap. That to me would be the strongest indication that we should trade lower, and we should trade lower with speed, and then go all the way into the relatively equal lows. It takes a couple candlesticks. It's not an immediate run lower, but I'm fine with holding it because we're fading the retail mindset. So the retail mindset are going to be looking to buy this because it just had a quick burst up from those up close candles, and then it's a bull flag, so they want to buy that. And then this right here that you're seeing these down close candles now, that's stopping out any of those bull flag traders, and it's going back down into that inefficiency. That inefficiency is where I conveniently have my partial. I know that if it's going to trade into that inefficiency, we could see some candle compression where it, instead of inverting that fair value gap, it uses it to trade higher, which is what we see later on, because this trade does lead to a stop out, but it's still a profitable position because the partial and trailing stop loss. Here I'm looking at this wick. In my mind, if it trades back up into that wick, I'll add another position, but only if it's like a perfect little rejection. So right there, it didn't touch it, but in my head, that's institutional for entry drill, and by it not touching the low of that wick, it's actually signifying more weakness than if it did touch the low of that wick. Then it gives this bit of a run lower, and I want to see that swing low closed through. So I don't want to see it meander through. I don't want to see it be slow. I want to see a really sharp push through a long stretched out black candle. That would indicate a really quick and a really speedy market that's going to keep going energetically towards my take profit. Right here we're through the market structure shift, but it's not going to close through, it's just going to wick it. Yeah, I don't like that. It's not invalid, it's just that when we wick through a market structure shift level, it's usually going to reach back into a short-term premium or a short-term discount if you're bullish. And short-term premium doesn't mean going into the upper 50% of the range, it just means fetching some kind of higher price. So in this case, I would think the lower half of the bounce price range, maybe it'll just touch the consequent encroachment level, or maybe it'll touch that bearish order block that you can see on the 1 minute. So I've taken my partial, and in my head I'm thinking that it's not delivering the speed that I would expect it to after a market structure shift like that, so I'm going to take a partial here. I'm going to be content with it, trail my stop loss to the point where it's a negligible loss, because I just got like 1200 off that partial, or 1100 off that partial, and then the stop loss is only like negative $100. So the position's paid for, and we're now in a free ride to the relatively good lows if it wants to deliver that. If it doesn't, who cares? You still made money. You were wrong and you still made money. That's a great thing. You don't need to be right every single time. So I was waiting for it to potentially deliver here. I know in my head that there's a chance this doesn't deliver because it's not giving me the signatures I need it to, because it's not fast in the market structure shift. And I look at this, I see that as a potential propulsion block. So you'll see I'm annotating in a moment, but I see that and I'm thinking, okay, if it closes down through this, then we'll get the speed that I'm looking for. It doesn't close down through that, and it trades higher, it hits my stop loss in a couple of minutes. But what we're seeing now, this mini retracement, is actually the buy side of the curve in what's going to be a market maker buy model forming. So I'm conscious of that. I know that we're in, and I just took the sell portion of the market maker sell model. I took my partial at the low, and I'm thinking that, okay, it's traded far enough against me. The last line of defense is this fair value gap, previously used as an institutional for entry drill, but it may tail sweep that high and then trade lower. If it doesn't do that, then I'll have to flip my bias and I'll look for higher prices, or I'll just close off the charts and I'll go to wherever I'm going to do. But it's important that when you're trading in these high resistance conditions, you have to look for time to be in alignment, and you have to look for the cleanness, because right now this isn't clean. Sorry, this is clean, but if you look at the rest of the price action of the day, it's terrible. It sucks, except for after 11 o'clock it was a nice little sell-off, but before that, we had 700 handles in, or 800 handles in like 2 candles in the morning. That's a very, very irregular price condition, and if we're going to have something like that, are you more likely to make money or lose money? You're more likely to lose money. So why don't you just give the day to the market makers, take the day off, go to something else, or if not, if you're really obsessed with charts, study, tape read, just don't be in trying to risk real money until it clears up. And if it clears up, you have to demand A, time is going to meet, B, you have a great draw on liquidity, and C, the conditions are low resistance. So here when we're seeing these candles and they're not overlapping, they're porous, they're displacing one way, they're going one-sidedly, it's clear, it's behaving algorithmically, it's respecting PD arrays, that's a low-risk liquidity run condition. That's an environment where you can be in trading. But in the morning, we didn't have that. We had that 700 handle move, and then everything turned high resistance, all the candles are overlapping. There was nothing worth being in. That's why I said this morning in the Discord, don't try and trade. Okay, this is a that trade now. I come back to this, I take a bathroom break, I come back to this, and I'm like, okay, we've already run a bit higher. I'm looking for an entry. My my mind is going to the suspension block, but then I see we've already broken off of it. Here I'm just measuring my potential risk reward. That's allowing me to look at where can I enter and where can I place my stop loss without being in like 0.4R, because you want to have a valid stop loss, but you don't want to be entering at a point where the take profit is going to be like $400 and the stop loss is 800. That would be crazy. So here I'm measuring of this inversion fair value gap. I know that if I can get an entry at the inversion fair value gap's high, the stop loss at the low of it, then this is going to be a nice little scalp, just a one-off scalp. This is a practice drill that you should, if you can, do this on demo account if you've got the time. On the demo account, when you're in the last 20% of a move, so you've already gone 80% of the way, and you're in the last 20%, a very, very good exercise drill. And here it tags my take profit, but it just doesn't fail me for some reason because TradingView demo accounts, they suck. They're just terrible. They fail you for like 5 minutes later, and if it doesn't linger above your take profit, it doesn't give you the full take profit. So it is what it is. It does give me the thing later, but I have to wait a few minutes. As I was saying, a good practice drill is to try and capture the last 20% of a move. So if you're on a demo account, which you should be doing on a demo account or tape reading it, what I do is I'm looking for, okay, here's my draw. We've already gone toward it. Okay, so I've missed most of the move. I can't get in a discount anymore. The only thing I can do, this trade should have already hit a profit, but it's so now I add one because it's an immediate rebalance on the 2 minute chart. If you look on the right, there it is. As I was saying, if you have a clean draw on liquidity, conditions are good, that's when you want to do this. If it isn't, you don't try and capture the last portion of the move because sometimes it can front run you and turn around at 80%, do a judo swing lower, a retracement in other words, and then slam into take profit. So it's a really weird thing where it goes like 80% of the move, then it retraces back to like 50% of the move, gives an equilibrium price point or a discount price, and then it runs into take profit or into whatever the terminus point of the move would be. So you'd want to do this in fast moving price conditions where there's breakaway gaps, there's clear indications that you should be going higher without retracement. Like we're seeing here, there's breakaway gaps, inversion fair value gaps are being respected. Everything's very algorithmic. So that's why I go in here. They just let me take a screenshot of my journal. I normally don't do display capture, I do window capture. This was an accident. So you have to have a clean condition, good condition. You have to have a clean draw. You have to have, like I said, breakaway gaps, algorithmic signature strength. And then you want to be looking for whatever your terminus point is, the last 20%, if you can see an inversion PD array from the left side of the curve. So if it's sell side of the curve, it's buy side of the curve, whatever it is, you want to try and get in on that as the last final piece of the move that supports the run higher or lower into your terminus point. And that is a very effective way of using your demo account because it's a good little practice drill. And so many times I've been on a live account and I'm just trying to scalp a couple moves or a couple points for the day, and that's all I've done in like a high resistance condition where price eventually yields and it turns low resistance. But I'm in there with the mindset, okay, this is high resistance, I don't want to get involved. And I realized toward the end of the move, this is gonna easily go into that sell side liquidity pool or whatever it is. I can easily just scalp the last 20% of the move. It's a really good practice drill. I'd recommend anyone does it, even if you're not interested in doing like a little scalping thing. It just gets you in tune with the market, and these practice drills, they're key to being able to read order flow in real time easily. At any point in the market, you want to be able to, if I just stick you in at a random price point, you should be able to tell me it's going to do this, it's going to go there, it shouldn't do this, and it will do this in order to go to that point. And by doing these little demo practice drills, you train that ability, you train that skill, and you make yourself effectively a better trader. Like, there's no other way of saying it. You have to put in the practice, you have to put in the time if you want to be a better trader. Drills like this, they help. And in my private mentorship, I teach a lot more. But even if you just do this, or if you just do something like trying to enter on the consequent encroachment of a fair value gap, or trying to buy at each swing high when you're trying to buy at each swing low when you're bullish, selling at each swing high when you're bearish, on a demo account, you'll really fine tune and improve your trading results.